Welcome back, everybody, to the Informed Home Buyer Podcast. I'm your host, Rich Curtis, and as always, I have my co-host with me. Welcome, Dave.
Hey, Rich, thanks for having me.
All right, so Dave, today we are going over some headlines. The headlines have been a little grim, the financial headlines lately. If you at home have been following along, it's not all rainbows and butterflies out there in the financial headlines, and it leaves people wondering, what does this mean for housing? What does this mean for my pending home purchase or my pending home sale or my plan to purchase or sell this year? And it's really hard to make clear-headed choices out there when there's just an avalanche of negative financial news. I think a lot of it is a little bit of noise that doesn't add up to a whole lot of change in our situation. But some of it is showing signs of cracking in the housing market. Some of it is showing signs that, as we said on our last podcast, we believe recession is already here. So we're going to point to those numbers for you so you can make some informed decisions. Let's start with a little roundup on the headlines, as not fun as that is. You ready, Dave?
Yep, I'm ready.
All right, here we go, guys. We're going to jump into the first one here. So Zillow came out and they predicted home prices will fall nearly 2% by the end of the year, this year nationwide. And I think with this one, we have to take it with a grain of salt. This is not me being, rose-colored glasses. I think we are going to see some pain in the housing market. I think we are going to see decreased values and decreased home prices by the end of the year. Would you agree, Dave?
I would agree, Rich.
I just think any kind of blanket real estate information or blanket real estate advice is not good information or good advice. So Zillow is real good with the nowcast. They're taking data and they're taking a snapshot of right now, and they're saying, based on what's going to happen right now, 1.7% nationwide was their actual estimate. Now, you can't tell me that beachfront property in Santa Cruz is going to go down 1.7% this year. And you can't tell me that Central Valley real estate isn't going to be hit harder this year if we really go into full-blown recession, as we believe we will. So the problem with this is just that it's blanket. I think we're going to see a lot more pain than 1.7% in a lot of markets. And some markets that are insulated markets might not see that much pain at all. So is Zillow correct that the trend is going to be down this year? I think they're correct. I just think this 1.7 number isn't really worth the paper it's printed on right now. And our predictions at this point are good up until the point at which we hit the stop button on the recording and check our phones and see what the news has done while we were recording. So I think to say that we know the number by the end of the year right now is a little bit of hubris. What do you think, Dave?
Yeah, I definitely think so. But I see the trend, and you're going to bring up a slide, and I don't want to jump the gun. And the one thing we haven't really, and I think I can mention it now, is, when we're talking about, and we'll bring it up again, is with home prices falling, we've had this lock-in effect since 2020 with folks with low interest rates that haven't wanted to move or sell their house. As a seller, if you've gained all this equity, but you haven't sold because you don't want to lose your 3% interest rate and go buy at 6%, well, there's a certain point where you're like, well, my home may drop by 2, 3, 4, 5%. I might lose upwards of $100,000 in equity if I wait. What's the interest rate delta for me to make that decision? So I think folks are going to be, as we are starting to see inventory increase, I think that's going to, in my opinion, I think that will accelerate with folks wanting to take that off the table now, thinking, hey, we got to get in front of this if we think, and the news is accurate, that pricing is going to drop, and I'm not so worried about the rate. I want to capture that equity that I have.
It's such an interesting point that you bring up. And I think, we don't talk about this as much in real estate. If you're an investor and you invest in the stock market, you'll play with the idea of when to take profits all the time. Not if you're a long-term value investor, just buying index funds and waiting for your retirement. No, but if you're doing a little bit of active trading or managing your own portfolio, and you've seen it with the big sell-offs after tariff announcements, people are like, oh, this might be as high as it's going to be this year. I'm going to take some profits. We don't often approach our homes the same way because moving is such a big ordeal. Easy to hit a button, sell a stock. Real hard to pack up all your crap and move your family. But if you have been wanting to make that move and you've been suppressed from that decision by the lock-in effect, we may be facing that that inflection point where it's time to consider taking your profits and doing what you've wanted to do before things get worse. So it's an interesting perspective for the sellers out there. I know it is the Informed Home Buyer podcast, but we do talk to sellers as well, and of course we work with buyers and sellers. It may be time to look at this data and decide when is it time to take some of those gains off the table real estate wise if you've been wanting to move anyway. It's never really a good idea to sell your house to try to take gains if you're staying put, if you're not moving. If that kind of movement in real estate, there's a lot of fees and a lot of costs involved in selling real estate. It's usually not a good idea to do that just for profit taking. But if you've been wanting to do it anyway, you can never really time the market, but now might be a time to look at taking some profits off the table. It's a really good point, Dave.
Yeah, and I would say there's going to be a backlog of folks that, I mean, based on the limited amount of inventory, there's a lot of folks that have been waiting to do this, right? Like for the timing, they've been wanting to do it and they just haven't been able to find a better option or weren't willing, especially with homes appreciating at the same time they had that lock-in interest rate. It's like making some money just sitting where I'm at and there's no better option. But I think there's a point in time, like you said, if you invest in the stock market, you want to sell high and buy low. It's probably, a lot of folks in that boat.
And we're already to that point. We're already seeing that in the numbers. So let's just we'll go back to some headlines, but let's just throw this up real quick here. This is the monthly March roundup of data for Placerville, one of my primary markets. And the thing to really notice here and really pay attention to is this box that's shaped like a house is the number of existing single family homes that sold in the month of March. Now you see that number is only 30. That's a small number. Placerville is a small town, within the 5 square miles of downtown Placerville, we got like 11,000 people. And, I think it goes to 23,000 for the whole zip code. So small place. So the number of sales there in terms of it just being 30 isn't dramatic. It's the year over year difference. So we are down sales volume wise year over year, almost 12%, 11.8% less homes sold this March than last March. Our active listings are up 37.7%. Now, that there is a seasonal component to this. 9 or 10% of that's going to happen every year anyway, because we're starting to make our march towards the summer selling season. But that would be reflected in a month over month. So if we were looking at month over month data, you might see a 9 or 10% jump from February to March, and that would be normal. Bear in mind, this is year over year. So that 9 to 10%, because people always say that, oh, it's just seasonal. That 9 to 10% of seasonal effect is washed out in the data here because this is year over year. So we've seen a 37.7% uptick in the number of active listings year over year, March 2024 to March 2025. Now we've had record low inventory ever since 2020. For the most part, 2 months or less of inventory. Again, folks, when we say months of inventory, that means based on the number of homes that are selling. If no more homes came on the market starting now, I'd be out of homes to sell in about 2 months. Now, we've seen that number go up to about 3.5 to 3.7 months of inventory in Placerville. So inventory is going up. You can see active listings are up 37%. Anytime before now, before the last 3-4 months, when we would see a jump, if we saw 8 or 9%, 10% jump in active listings, we would see a commensurate jump in home sales, meaning the buyers that were sitting on the fence that couldn't get a house just jumped off the fence, gobbled up all those listings as soon as we got them. So your inventory would spike and come right back down, spike and come right back down. And the annual through line would still be in that 2-month range. And that's not what we're seeing now. We're seeing those active listings go up and the sales go down. And that is a bad sign that buyers are pumping the brakes, that buyers are staying on the fence or jumping back to the other side of the fence and just saying, this year's not my year, with all of the, as Dave refers to it, the FUD, the fear, uncertainty, and doubt in the marketplace. And we've got some data coming in to support that in terms of polling as well. So Redfin has said 24% of Americans, so roughly 1 in 4 Americans, are scrapping plans to make major purchases like houses or cars due to the tariffs. So that's reflected in those Placerville numbers. I've seen we're down 12% in terms of active sales because people are pumping the brakes. Now, to Dave's earlier point, as that inventory is naturally rising because the lock-in effect is easing and people want to get on with their life, or some of them are maybe taking profits because they've been wanting to get on with their life anyway, those active listing numbers are going to continue to increase. And if we don't have a commensurate increase in the number of sales, that is what creates downward price pressure in the marketplace. And that's what Zillow's already picking up on. And that's what's driving the narrative that we're going to see declines in property values over the course of the year. And so we're already seeing that kind of show up in the data in the early stages. These are sort of cracks starting in the dam. So I think it's pretty fair to say that we are going to see more pain as we go into the summer selling season and into the fall if there's not a full reversal on the fiscal policy coming out of Washington. And even if there is, a lot of economists are saying the genie's out of the bottle there. And one last headline we'll point to, and then we'll jump to Dave for some interpretation on this. Reuters, this is hot off the presses this afternoon. Reuters is saying that the Fed has signaled that rates will remain unchanged despite market bets on looming cuts, meaning the upcoming Fed meeting, we don't expect necessarily a change. But deeper in this article, they have said they are expecting to see 4 Fed rate cuts of a quarter point for 1 full interest point reduction by the end of the year. So, Dave, we've been saying we don't see rates changing. I've been saying that on the pod a lot, really appreciably by the end of the year. So talk us through, I've got some questions for you. If the Fed really does do 4 quarter point reductions and we get a full point off the Fed rate, is that going to reduce mortgage interest rates by a full percentage point? If not, why not?
Yeah, Rich, been saying all along that I don't think that's going to happen. And we saw it last time that the Feds lowered rates. We might see a short little window of euphoria and like, hey, rates are coming down, but it really comes down to the bond market, and what's going to stimulate the 30-year mortgage-backed security is an infusion of cash and the bond buying, which oftentimes happens when the stock market is depressed or there's some fear there, and then people take the safe haven to bonds. But what you and I have talked about is with all this uncertainty, all this tariff talk, a lot of people are still on the sideline in cash. And and we're talking major investors too that are moving the needle on these bond buying programs, that if we don't see the investment in the bonds and the safe haven to bonds, we're not going to see a steep decrease in mortgage rates. We might see a small little movement. I would expect that we'll see, if they lowered a full point, we might be low to mid 6s. Right now we're high 6s to touching 7. But I would probably bet on, cut that in half. If they lower a full point, I would expect that most we're going to see is a half a point reduction in mortgage rates.
And is it fair to say that there's likely going to be some volatility in that too, where, we might get, like you say, a little euphoria and rates, mortgage interest rates get better for a bit and then they get way worse. And then they kind of settle back out into where they're going to be, which is what we've kind of been seeing with all this, on again, off again tariff business this year.
Right. You're right there. And I think what a lot of people are doing and what we're seeing this increase in inventory is buyers want to see one of two things. They want to see lower interest rates and take advantage of that and go buy a home, or they want to see home prices come down. Well, if home prices are coming down, but interest rates are still the same, you'd think folks would want to dive in. But the fear with the economy and job status right now is what's precluding people from taking advantage. If we are going to see a decrease in, that 2% in value, or value in homes start coming down, I don't know that we're going to see, a mass influx of folks trying to take advantage of that because of the fear and uncertainty and doubt of the economy and their job status.
Yeah, and I think we're seeing a lot of economists sort of point to this, and they're now predicting like soon, like towards the end of the summer, beginning of fall, COVID level like shortages, empty shelves in the stores, and a lot more job loss. Because what people don't understand is what companies are doing right now. This pause, even though the pause and the tariffs gave all of us maybe an emotional sense of relief. Oh, we don't have to deal with the fallout today. It's probably economically the worst thing he could have done, because it increased that fear, uncertainty, and doubt. Now nobody knows what the hell is going to go on with the tariffs. But also what it did is it told companies 90 days from now, everything you buy, import, every part you use to build what you build, even if you're building it on American soil, almost nobody is building something in America that has 100% American machine parts and everything comes from this country. They're getting bits and pieces from overseas. And Trump just told all of them 90 days from now, it's all going to get a lot more expensive and a lot worse. So what do? They started importing the hell out of everything they could right now before the tariffs got on. So we're seeing companies with massive capital outlays right now to bring in things before the tariffs to put on the shelves. And then they're not going to import anything once the tariffs start. And then we're going to have, ships staying, offshore. We're going to have ships not coming from Europe and from China and from these other places. And so once that initial push of things they bought gets gobbled up at the store, we're going to see empty shelves. And then people are going to be grappling with what level of tariff is it now? How much should I import? And then they're also ramping down by layoffs and firings their workforce because they're saying, hey, we're not going to need you. We just piled up a bunch of stuff and we're not going to do any more. We're not going to need you for a while and we need to financially contract. And we're going to see those job losses pile up. And so even with lower interest rates and even with lower home prices by the end of the year, people aren't going to have enough security in their job, or they're going to have seen their cost of living go up so much they're not going to be willing to pull the trigger on a house, and that's going to have the big effect on the housing market.
Yeah, and the other thing too, Rich, is not that long ago from COVID era with supply chain issues, if companies are stockpiling goods right now, try to get in front of the tariff. Well, if there's some adjustments on those tariffs, you don't just turn the dial and all of a sudden those goods are on the shelf. Like you said, there's going to
or
be
in the port.
In the port, there's going to be a supply chain issue, and that takes quite a while to work itself out, as we've already witnessed. And so, and then the issue with the dial being changed mid, up and down. Is it on? Is it off? Is it in between? Are we carving out some sectors? What are we doing here? So it's such a moving target that it's not something that we can easily get back into smooth waters again.
Yeah, and it's already happening. I think people think, oh, we paused the tariffs, so the effects aren't happening. But the effects are happening. Like any brand you interact with, we buy these Turkish towels for taking kids to the beach. That company is running massive sales right now on standing untariffed inventory to boost sales in advance of the tariffs, and then saying prices are going to go up. Wristwatches, you're talking wristwatches from Japan, a major exporter of reasonable, like affordable. I'm not talking Rolexes out of Switzerland, just like Japanese, watches, your G-Shocks, your everyday watches. We're talking 25% increase in the price of those, just right off the bat. So every industry, we do a lot in my family, we do a lot of off-roading and camping and overlanding. All of those people who make those products, a lot of them are buying raw products from overseas to build campers and stoves and all that. We're seeing a lot of those people already announcing on their social media platforms increases in prices. So regardless of the on again, off again business, these people have to make business decisions so they can move forward with their year and sell products and know they're going to be viable. And the only solution right now with this kind of insanity to ensure your viability is to decrease staff, decrease production, increase prices. That's the formula to try to survive this if you can't get your mind around what it's actually going to, just be moving forward. And so all of that is going to contribute, I think, to the job losses. And Dave, I would expect, is the expectation right now that at the next Fed announcement, we're going to see, increased job loss numbers?
Yeah, certainly. So that's the way it appears to be trending. And, ideally that if that's the case, that inflation remains tame so that the Feds can turn that dial and try to stimulate the economy or pull that lever, so to speak. You never root for it, but unfortunately, that's kind of what you need to have happen to get them to, lower interest rates, to help businesses to, invest and stimulate the economy. So.
Yeah. And that, I think, is the unfortunate thing, is as we talk about the only bright spots for the housing market being reduced interest rates and potentially reduced prices. And I think people think that realtors are not for prices coming down, but believe me, we live here too. We're in California, one of the most overpriced real estate places in the country outside of New York City, right? So we're all in favor of affordability. When houses are more affordable, people buy more of them, and that's how we feed our families. So I don't mind prices coming down at all. But unfortunately, in this case, if prices come down and if interest rates come down, it'll be because there's a lot of job loss and financial pain out there that'll mean everyday working families might not be able to afford the home they've got or the rental they've got, never mind purchasing a new one.
Yeah, and I think where the areas where we work, Rich, you nailed it, is we want to see, at least with those price reductions, even if interest rates maintain the same, just the buyer demographic be able to increase. And,
Yeah.
folks that are, people don't want to be perpetual renters and they want to live in the area, but they can't buy a house. And I would love, some things have to change for those folks to be able to afford to buy a house and not have to live with 7 people or 7 different families just to make it work. Right. So,
Yeah.
um,
Yeah. And I
we
mean,
root for that. Yeah.
this is a perpetual problem in California, but it's gotten much worse since COVID. Now, for those of you thinking about making a decision, so how do we start to frame our thinking about making a choice right now? So, I was going to buy a house in 2025. That was my plan. I've got my down payment saved up. Maybe I lost some of that down payment in the markets. Maybe I didn't. All of this fear, uncertainty, and doubts coming at me. Home prices might be lower. Interest rates might be lower. Should I be waiting? How do I decide? Again, I think this comes down to the fundamentals. We have a whole podcast on this, but we talk about this a lot. Do you have an emergency fund so that if you lost your job, you could cover, your lifestyle for 6 months, 8 months, whatever? Are you a well-qualified buyer? You have good credit, good savings, all of that, ready to go. Are you making a long-term purchase decision? Could be in this house 5, 10 years. All of those fundamentals that we talk about, the 5 fundamentals, that is the first step in assessing whether you should even be thinking about playing around in a market that's volatile like this. So I'll put that pod up again on the screen at the end of this one, and I'll put a link to it down in the description down below. Listen to that one, make those assessments. If you meet those criteria, then it's time to get on the phone with a lender, time to get on the phone with a realtor and get some realistic expectations of what's happening in your market. If you are starting to see some cracks in your market and things are starting to decline and you see some stable employment, it could be reasonable to pump the brakes for a few months, but still looking to take advantage of opportunities this year. But if you don't meet those 5 criteria, if you're an on the edge buyer financially, now is not the time for you. And if you're a seller, look at the gains you've made, get a realtor out, give you comparative market analysis, look at the appreciation you've gotten, especially if you bought pre-COVID. You've absolutely skyrocketed in value. And if you've been planning to move and live near grandkids, something like that, maybe now is the time to take those profits and bounce. And you need information from a trusted professional to make that choice. Wouldn't you agree, Dave?
Yeah, I agree. Unfortunately, we're talking about a lot of noise in the economy. I got someone with a leaf blower outside here, so I'm trying to go back and forth, but there's always noise. And I agree with that. And I think the other thing for a potential home seller, and we talk about all this time, so unintended also appreciation. You didn't know you were going to get quite the appreciation you got over the last several years. And if you were to list your home today or even list it for 3 or 4% below market value today because you want to move it, that's okay. You're never going to maximize the 100%. You're never going to time it perfectly. So if you were to list your house, and I'll just use a round number, for $50,000 less than what you could have sold it a year ago, well, you got $100,000 a year ago. So you're not really taking you're taking a little haircut, but you're just never going to time it perfectly, just like you're never going to time it perfectly when you buy. And so I think that's what folks have to wrap their, heads around. If you're a seller, is, I can't be at the top of the market anymore unless some really uniqueness going on. If you want to move your property, you got to price it accordingly. And we might start seeing some competition there where folks are, forced to lower their price below what they were anticipating they could sell it for, but you still made tremendous gains and you didn't time it perfectly. That's okay.
Yeah. I think a good example of that is if you look at the numbers for 2022, and I didn't prepare for this, so I don't have the slide, but we had seen so many gains the first 6-7 months, so much appreciation in 2022 in prices. And then the interest rates, from July to the end of the year doubled and the whole market came to a screeching halt. And we saw some losses, but like in Placerville, it was still a net, like close to 2% positive for that year because we had just gone up so far that even with the losses, it turned out to be a net positive by the end of the year, even for what was one of the worst years in real estate up here out of the last 5. So, and then we are starting to see, to your point, we are starting to see in the numbers here in the bottom right corner of this slide, you can see the percentage of active listings with reduced prices. So in March, 35.8% of listings in Placerville had seen at least one price reduction over the course of their listing cycle. And price reductions have been relatively unheard of over the last 4 years since COVID. So
And I
we
have a
are.
question
What's
on
up?
that. As a realtor, Rich, is it fair to say a lot of times you're going to get a price reduction because maybe it just wasn't priced right to begin with as well? It doesn't, I mean, you and I have experienced this a lot. And I know that when you do a listing appointment, and if you were competing with another realtor, it sounds great that someone wants to sell their house for $50,000 more than what you're saying it is. But, if they're on the market for 3-6 months, they might not only have missed out on that 50,000, they waited so long trying to squeeze an extra 50,000 out of it that now they're below what the fair market value was.
Yeah, there's a lot that goes. We could do a whole podcast on pricing. Maybe we should do that at some point. But yeah, there's a lot that goes into that. The way that buyer behavior is now, because everybody searches online, if you nail the price of the home exactly right, you get the attention of 60% of the buyer pool online. If you blow that number by 10%, that drops to in half to 30%. And you pretty much can't sell anything if you only have 30% of the possible buyers looking at it. So pricing is really important. There are some regional or local differences in this. In the Bay Area, and we do have a lot of people relocating from the Bay Area. The real estate market is bananas down there, and people pricing $100 grand, $200 grand under asking regularly. It's just part of the game down there. To me, it's very disingenuous, very hard on buyers. I really hate it. I don't like working down there for that reason. But if you're in a market where people are pricing accurately and you blow it by 10%, then that can have real disastrous effects, and you end up selling for less down the road. You have to do more price reductions. You get beat up on the price. So some of these price reductions will definitely be people who just weren't willing to be realistic up front. Some of them will be people that are just catching the early waves. So when you get a declining market, people's expectations lag behind those declines. And so people are pricing based on the old market and then chasing the market down, which also results in an overall, at the end of the day, lower sales price, unfortunately. But there's just some consumer behavior piece to that that's almost unavoidable, where sure, you're telling me the market's declining and it's dropping, but I'm not ready to eat that money yet. I want to at least put it at my price and try. That does have negative effects on people that sometimes can't talk them out of it. So a certain percentage of those price reductions will be people that the prices are starting to adjust and they're just not ready to accept that. In fact, go ahead.
I was saying that's what I appreciate when working with you. When you're working with buyers, you're candid with sellers of where they should price the house, but also working with buyers. If a buyer, you tour a house and they like it, and we've seen this happen a lot, like, yeah, I know you love this house, but it's 50 grand or 100,000 overpriced. I'm going to call the realtor and let them know, hey, you probably don't have any offers. We're going to submit an offer. It might offend you, but this is what the comps are showing. And
and there's going to be a lot more of that moving forward this year, unfortunately.
Yeah.
And having to make that case with data to people.
Right. And, there might be one off that they actually get a number, but I think if you're working with someone like yourself that understands the market and the comps, write an offer and, you might get it at the price you're looking for. And that's no fault of the seller. They just overpriced it because they want to maximize it. But the reality is, it's only what someone is willing to pay for the home is what you could sell it for.
Yeah. And we're just seeing the beginnings of that in the data. In fact, I just comped a house for a listing appointment tomorrow. And for the first time, the price that is defended by the sold comps is higher than the price that would be defended by the active comps, which hasn't happened, in a decade, right? Because we had the recovery from the Great Recession. We had all this COVID insanity. And so almost always list prices or wishes and dreams are almost always higher than what the sold prices defend. And that's in any listing appointment, there's always a certain educational component of saying, I get it, but here's what people are actually paying for stuff. Here's the solds. And this is I go on listing appointments all the time. And literally just this week, I ran the numbers and was like, oh man, the actives are coming in lower than the solds, which is again, one of those first signs of decline in the market. And that's even a harder educational component and piece to have with someone, which is, hey, the solds say you can get this much, but look what your competition is now on the market. And you have to price against your competition. And so we're starting to chase the market down a little bit. And the data is just starting to show that, unfortunately.
Yeah.
And we'll continue to bring that to you guys week after week if that persists.
Yeah. And the other piece, and maybe there'll be another pod for that, Rich, and when you're working with the buyer and you're working with that seller, is there's that lag when you buy a home and you get a mortgage. If you're, there's an appraisal that needs to come into place, and typically these appraisers they're going to use like comps that are 90 days old. Well,
Yeah.
we're now in that market where you might list your price, fair market price, buyer come in, but the recent solds are now going to be below what that comp price is, and so we start to see issues there. So again,
Yeah.
if more important as a seller, don't try to hold on to everything, because if the actual solds, the equation that you just pointed out, even if you try to maximize an extra 15, 20,000, if it doesn't appraise out, you're renegotiating the price 30, 60 days down the road anyway.
Yeah, and again, everything in real estate is kind of data wise in the rears, and so I think what you're talking about, we're going to start to see that late summer, early fall. So right now we're at the point where the market's starting to decline, and we're seeing active sales being less than closed sales. Once those lower actives start to close, we'll start to see the closed sales drop. And then if sellers aren't able to come to where the market is now, we'll see those appraisal problems and appraisal gaps. And those are things, they just happen, folks, and we work our way through them. It's usually not a deal breaker, but it is an expectation piece in the market that we're going to have to keep adjusting as we go along this year. So for you guys, it's great that you're here watching this. It's great that you're getting informed, because it'll be easier for you to make those choices, because you'll have a sense from us already of what the market's doing. So even if you're not in our market, if you're in our market, we'd love if you give us a chance. Call me and Dave, come out and help you out. But if you're not in the Northern California market, or for Dave, he does loans in all of California, Nevada. If you're not in those markets, and you're just bringing in your other trusted professional, you already know from us, well, hey, we're chasing the market down. I should expect to see a number that is unfortunately a little less than I'd like at that listing appointment. And you'll be in a position to work in lockstep with your trusted professional to make better decisions, which is ultimately our goal with this podcast, which is always to help you make the best real estate decisions you can from the comfort of your couch. We're 31 minutes into you listening to Dave and I prattle on about some rough economic news. If you made it this far, you were either a sadist or deeply committed to your own financial education, and we appreciate you either way. As always, thanks for watching. We'll see you on the next one. I'm Rich Curtis.
I'm Dave Miller. Thanks.
Bye, guys.